Okay, so let's go ahead. Hello, everyone, and welcome for the third season of the EDHEC Virtual Speaker Series on the Future of Finance. I'm Ilmanen. I'm the Director of Graduate Finance Program here at EDHEC, and it's my pleasure to welcome you today. So today, I will have the pleasure to co-moderate this session with my colleague, Professor of Finance Abraham Louis. So Abraham is one of our experts in asset pricing, portfolio construction, and so forth. And it's my really great pleasure to introduce our guest speaker for opening this new season. So today we have the pleasure, in fact, to have Antti Ilmanen. So Antti is a principal and global co-head of the Portfolio Solution Group at EQR Capital Management, which is a really big investment company, global systematic investment firm. Antti, he told me not to tell that, but I will say that Antti holds a PhD of finance from the University of Chicago. We just learned that his supervisor were Fama and French. And Antti is not only a renowned industry expert who advised so many institutional big investors, he's also a prolific author. I've written numerous research articles published on so diverse but important topic for an investor. Could be about the diversification of risk, could be about the macro sensitivities of asset classes and so forth. He is the author of really two important books for an investor, Expected Returns, and more recently, edited a book, Investing Amid Low Expected Returns. Both are reference for professionals, but also for academics and students. So we are very fortunate to have Antti today, and today Antti will talk about how it might be a bit difficult to invest during these specific and adverse conditions. Without further ado, Antti, the floor is yours, and again, thank you very much for accepting our invitation.
Merci beaucoup, Emmanuel. Okay, and that was all the French now for this session from me. I'm sorry. Let's see. I check whether I can get the full screen version up. You tell me if you can see it.
Yeah, perfect.
Very good. Okay, so I will talk about investing in adverse and interesting times. And so I could have used the new book's title. So the book came out 1.5 years ago, and by the way, like pretty good time. I feel a little proud that it came. Like I wrote it, sort of seeing some troubles ahead, but I was emphasizing that it's not just near-term troubles. This is long-term challenges for investors. But there was a possibility that the book could have become obsolete during 2022 because interest rates rose a lot, and you could ask, are we still in a world of low expected returns? And I will argue that for most assets we still are. But I had a chance to write the paper early this year to Journal of Portfolio Management, sort of updating the message from the book. And I decided to sort of bypass the question on is it world of low expected returns. And I used the title Investing in Interesting Times. And this is based on this apocryphal Chinese curse, may you live in interesting times. And I do think from macro perspective, this is very interesting times for us investors. But let me combine in this presentation both telling what the book is about and then the more current thinking. So I will update this, and I will, well, let me already just say here that the book had 3 parts. Of the first, the low expected return challenge, and then I'm going to talk about how things have changed after the book came out. And then it talked about the building block, basically getting to the answers to this challenge, and which are building blocks of various portfolios, asset class premia, style premia, illiquidity premia, alpha, those types of things. And then the third part is how to put those building blocks together. And on that one, I will emphasize in this presentation question on risk management, risk mitigation, because ultimately, I think the most important thing for many portfolios is this question: how do you deal when the key risk in your portfolio comes against you? And often that is equity market directional risk. Anyway, we'll get to that. But so first, I'll always have one slide on these highlights of each section. And in the first one, again, this is slightly outdated now, but so I'm saying that there was a 40-year window, and you'll see a picture soon, of ever more serious low expected return challenge. And during this period, when expected returns on various assets were falling, realized returns were quite good, giving investors windfall gains. And there was a danger that investors therefore take a very complacent view on the world, because the rear view mirror of past returns was telling that things are just fine. And I will argue that this is not the case. And I will talk about the way I saw it, the situation at the end of 21, and then how things have now changed in the last 1.5 years. But I will just the bottom area on this page talks about some things I don't really cover too much in this presentation. I almost call the book Serenity Prayer, which talks about the importance of understanding the things that you can control versus what you cannot, but also the idea of being patient. And so my short story there was that when we got these lower expected returns, many investors didn't say that, oh, markets are offering less, therefore we should accept less. Instead, they were saying that, oh, we want to keep earning what we are used to earning, even if we are in a zero-rate world. And that, of course, was unreasonable, but it led to all kinds of reach for yield approaches. Anyway, so when I get to the I'll tell you more, but something that I don't highlight much in this presentation, but I think is very important. I talk in the book a lot about investment virtues and bad habits, and one very important virtue is patience. I've become more and more, appreciative of the difficulty of patience in investing and the importance of it. Basically, it is so common for us investors to lose faith in something after a bad year, or at least after bad 3 years or so. So sort of the 3 to 5 year tends to be the max. I tend to say that only equities are forgiven a bad decade, but everything else loses assets after 3 years. And this is serious. This is a problem, I think, for investors. Anyway, let's go to the core story. So I like to start my presentations, and also in the book, this I think is pretty much the first chart. I've got more than 100 years of expected returns, and I show US data, partly because it's a big market, but also because it allows me to take such a long history, go back to 1900s. Would be harder. You can do that with realized returns with other markets, but with forward-looking returns, that's harder. So these are expected real returns using some simple metrics. Top line is for S&P 500, and the other line in the top panel is 10-year government bonds. And then the lower panel shows the expected real return for 60/40 portfolios. And these, again, very simple yield-based measures, pretty much for equities, it depends on dividend yields and earnings yields. And for treasuries, I'm taking 10-year yield and subtracting some measure of inflation expectations. We have 50 years of survey data, and further back, I have to use some statistical estimates to get inflation expectations. And the story I was emphasizing in my book was that both of those lines were near all-time lows when I was finishing the book at the end of 2021. And that was true for many other asset classes, and not just in US. And so we were in a world where everything seemed expensive versus its own history. And I want to tell the story rather through the lens of the 60/40 portfolio you see in the lower panel. And it tells that through much of 1900s, there was basically no particular trend in expected returns. Investors got 4 or 5% real return just by participating in financial markets. And there was cyclical variation, but not a trend. Whereas last 40 years, pretty much anybody's, including like I started in 1980s, anybody's investing lifetime experience has been dominated by this downward trend. 40 years ago, we were in this world where all major assets were cheap, valuations were low, starting expected returns therefore were high. And then we gradually got these 4 decades of ever lower expected returns, therefore higher valuations, and we got to this opposite world, okay? And effectively, we were borrowing returns from the future, because if we hadn't gotten so much richening, we would have had more modest returns in the rear view mirror and better prospective returns. But we got to this pretty extreme situation. And I was saying in the book that it's clear that eventually this is going to turn into not just low expected returns, but also low realized returns, which we so far hadn't gotten because of these windfall gains. But so whether this would come through slow pain of tiny coupons and dividends or fast pain of cheaper assets was unclear. I was leaning a little when I was finishing the book towards the fast pain scenario, because the picture of inflation and policy tightening was sort of becoming quite severe there. Anyway, and that's how it turned out. The shaded area there at the right end of this picture shows you what happened in 2022, and you may remember, and this ends in July now. So basically, we've gone from this all-time lowest expected returns to somewhat higher, but it's still a world of low expected returns. And especially when you look at the top panel, you see that most of the adjustment that we saw in 2022 was in the bond side, not much in equity side. And I'm going to emphasize this. And let me just, like, if I give one summary thing from this, is that most things in investor portfolios, basically any long-only assets, should be priced by thinking about expected future cash flows, discounted by the real riskless rate that's common to all assets, and then some asset-specific premia. Even if nothing special is going on with those expected cash flows or premia, if we are in a situation where that common real riskless rate is at all-time lows, as it was with those negative real yields in major markets, then everything can be expensive at the same time, which is exactly what we saw a couple of years ago. So it was a world of pretty much everything expensive because of that common riskless rate, not because of compressed risk premia. And this has totally flipped now in the last 2 years since I wrote the book. Bond rates and cash rates have risen, and many other assets have not adjusted. And now we are in a world of compressed premia. And my nice, just one summary, and I actually don't know now what it is with French inflation-linked bonds, but US 10-year TIPS yield rose from -1% to 1.5% to +1.5% during 2022, and now it's risen to something like 2%. And many real assets have decided to indicate that nothing to do with us, not very realistic to me. Okay. So if I turn to our capital market assumptions, which is a little bit fancier way of looking at expected real returns for various assets, we publish this, it's in our AQR website. You could see there every year. We use a bit fancier metrics than what I mentioned earlier, but broadly speaking, a similar story. And the story in the top panel is that there was not much going on between 2020 or 22, of course. Capital markets moved, but these expected returns didn't change too much year to year. But since early 22, we've seen increases in expected real returns of cash and all fixed income assets, whereas equities, real estate, private equity have hardly moved, and private equity has even gotten lower expected returns because of the worse financing conditions. Okay, and the lower panel here just tells the same story through the lens of premia over cash. So we put that lowest line there into zero. Everything is expressed as a excess of cash returns. And again, you can see the convergence, basically how we have shifted to this world of compressed premia. And what I showed here now is all about expected returns. Now I will show something which is coming from our very fresh research that came out a week or two ago, where we have asked the question, so what about realized returns? How different are realized asset class returns when you start from low rate world versus high rate world? And it turns out that it's very similar to what you see in this picture. Okay, so in the top panel, I show how we did the exercise. In this case, we are taking history from 1972, so about 50 years of data, and we look at US T-bill rates. And this could be very simple. I could just look at the 50-year median or average and say when were rates higher or lower than average. But we decided to do a little bit more complicated analysis, although the results would have been very similar from that simple analysis. But the simple analysis has got a couple of real question marks. One would be that really in 1970s, people wouldn't have, of course, any clue whether those rates are high or low compared to the next 40, 50 years. They knew about it compared to past, but not compared to the future. And more importantly, perhaps, when you think of what people think in today or at any point in time rates, they don't necessarily look at the 50-year window. If anything, it seems that people's memories are more like last 5 to 10 years. So the typical, I think the best way to interpret why we have got these inverted yield curves today in the US is because people are looking back to the decade of near zero interest rates for treasury bills, and they expect normalization to that, not normalization to the last 50-year average. Okay, anyway, so we are combining basically this full picture of last 50 years with more local measures, whether rates are high or low. Doesn't really matter how we do it, we get very similar pictures in every way. The key results are on the bottom left chart. So the lowest line shows a mechanical result. When we go from low rate world to high rate world based on our construction, cash rates are 2.5 or almost 7%. Everything else is more interesting than the mechanical point there. Above that, you see that treasuries held up pretty well. They basically acted a bit like cash plus investments. They gave higher returns in high rate world. Whereas you can see that equities, real estate, and high yield bonds basically got lower total returns, and therefore even lower excess returns when we move to the high rate world. And so this is about realized returns, but that's consistent with what I was showing about these forward-looking measures. And then on the right-hand side, I'm asking, what about long-short strategies? Like could be hedge funds, could be some alternative risk premia. I'm showing here trend following at the top, some proxy for it, and below that some long-short equity factors, value, momentum, and quality signals combined together. Okay, and they seem to basically act like cash plus. They have earned at least as much higher returns as the cash increase that you see here. So that makes sense because these are long-short strategies, and this evidence is just suggesting, well, they seem to act like that. So we do think that the story is that basically looking ahead, we are gonna get more useful portfolio contributions in a relative sense from treasuries and from long-short strategies than from the typical risky assets. Okay, so that was this new research. Now I've got a couple of more slides that I wanna tell about.
Antti, just if I may, so what is the economic motivation or intuitions of why equities, when interest rates are higher, why they are characterized by a lower expected and realized return?
Yeah, I think it is. It maybe one intuition is that the low rate world is very easy monetary policy. Also, equities tend to like easy monetary policy and low inflation. And they certainly haven't historically liked rising rates or rising inflation. So in the high rate world, maybe those types of effects have dominated then. That's the best intuition I have. By the way, I had written 2 books about expected returns on various assets, and I had never done this analysis. So I'm a little embarrassed that I'm doing this in 23 and not in the 2 previous books. And I was a bit surprised with these results, but there had been a hint of this in some studies by Robico, David Blitz, and David Blanchett, I think. I think we've taken it a bit further, this analysis, but basically all of us have found with various methods. And by the way, we've done this analysis also starting from 26 or starting from 1990, and we get very similar results. From all of this, it seems to be a pretty robust pattern that this comes, and yes, it's fair to ask questions. And my best answer was this equities disliking inflation and policy tightening.
Thank you.
Okay, so now so originally from 1980s onwards, I was a bond guy. I've always been very interested in understanding government bonds, and my actually first claim to fame in 1990s at Salomon Brothers was 7-part series, Understanding the Yield Curve. And soon after I'd written this series, I had a paper in Financial Analyst Journal where I did this type of analysis, decomposing treasury yield to 3 parts. And by the way, I do know that French like more modeling than something lowbrow empirical like this. So one can do this with various term structure models, and such decompositions are available in Fed's website, for example. But I always like the simple thing of hearing from horse's mouth, from economist surveys, what are inflation expectations for the next decade? or what are the treasury bill rate expectations, riskless rate expectations for next decade. In US, we have got 40 years of such data. In Europe, we only have got maybe 8 years or something like that. Such data has been now public. But if you have got such thing, you can basically decompose 10-year treasury yield, as I do on the left-hand side, into 3 natural parts: expected inflation, expected real short rate, so roughly speaking R star, for those who follow that literature, and then required term premium or bond risk premium beyond expectations. And there's a nice literature on all of these, and it's interesting to think about those 3 components separately. And I've taken those 3 components separately on the right-hand side picture. So really same content, same information, but just shown a bit differently. And the key point, however you look at this, but maybe now on the right-hand side picture, it tells that in the last 40 years, all 3 components were trending clearly lower, coming from very high levels to very low levels, and all were very, very low in 2021. And then all of them rose in 2022. And basically, the biggest increases were actually on the expected real short rates, policy rate, and required term premium. And inflation expectations have been surprisingly stable when we look at long-run expectations, while we've had this big round trip of inflation going up to 8-9%, and now to half of that. But I think the game is still open. It is going to be a question whether this is just a 2-year story or whether this is a generational change. That to me is one of the reasons why I think these are these interesting times. Ultimately, I think, for example, I think that when you look at the red on the right-hand side picture, you look at the blue line and the red line, they show that in 1980s, we had a very big required bond risk premium when inflation was high. And I think in particular, inflation uncertainty was high. I interpret this as largely as in world of high and unstable inflation, you have got a big inflation risk premium. And that vanished in 2000s when inflation expectations stabilized. And now it's a question whether that's going to come back. That is still an open question. Some of it has come back, but there could be much more. So that's something interesting. And another point that I have highlighted in my research over the years is that there was, of course, this change in stock bond correlation from positive to negative. Government bonds became 20-25 years ago negative beta assets in CAPM sense. And so they became nice safe havens for equity-dominated portfolios. And based on simple theories, that could justify a negative risk premium. And I think that was part of the reason why this term premium was negative and why it has been rising, because of the next chart. Because when we look at that stock bond correlation, which I just highlighted, that has got a history which looks sort of odd, that 1900s, there was a clearly positive tendency for this correlation, and then it turned around the millennium and has been 20 plus years negative, and now there's a question whether it's going back. And I'm a little proud in saying that I was one of the first ones to write about this just around the millennium, and actually having some ideas that the sign might be flipping now. I got that idea around the LTCM crisis and was writing about it in early 2000s. So Norway's sovereign wealth fund that I advised in 2000s, they were still talking of plus 0.3 correlation. And I was saying that it might be minus 0.3. And there is an old joke that Fisher-Black supposedly said, we know this stock bond correlation is 0.3. We just do not know the sign. And I think that remains somewhat open. But anyway, I'll just quickly tell the story. Like we have got some research on this that we came out maybe a year ago or half a year ago, which sort of gives our best explanation. Why did the sign flip and why might it flip again? And roughly this is the story. Stocks and bonds are driven by growth and inflation news. Growth news tend to move the two asset classes to opposite directions. Inflation news tend to move them to the same direction. Neither stocks nor bonds like higher inflation. And so then it's a question of, do we have more growth-related uncertainty or inflation-related uncertainty? In late 1900s, we had more inflation-related uncertainty, and that was pushing the asset classes to the same direction and was giving rise to positive stock bond correlation. And then around millennium, inflation expectations stabilized, and we've been now 20 years in a world where growth uncertainty has dominated and with negative stock bond correlation. So now I'm then saying that, again, if this inflation uncertainty rises, this could be yet another reason. Well, it would be a reason for stock bond correlation to turn positive, And then I'm saying that would be yet another reason for government bond yields to rise further, because the safe haven premium would vanish. So again, interesting times indeed for investors. It's unclear which way this is going. Break-even inflation and consensus forecasts are saying that we go back to 2.5% inflation and stay there. Ain't sure that that's going to happen. May happen, but that would be a very, I think, lucky outcome. Okay, so that was sort of the macro part of my discussion. Now I want to go back to very briefly to this challenge of low expected returns that investors were facing in 2010s. And I just repeat first something that I already said. It was not common for any investor to say that, oh, markets are offering less, therefore we should save more, and we should accept that we are going to earn less in the future. Instead, many investors said that we want to keep earning what we are used to earning. Let's reach for yield, reach for return. And this is what historically investors have done pretty much whenever. And it was just a matter of how they do it, more equities, more illiquids, or more factor premia. And it turns out that all were on the table in 2010s, but more recently, it's been very much illiquids that are getting all investor attention. Okay, I think I'll just quickly say, I'm going to speed up a little in this. I think it is helpful when you think about your portfolio components to think about these building blocks. I use this triangle in my book to highlight that you can think about market risk premium, alternative risk premium, alpha, and illiquids, and at the base you have got cash, which was 2 years ago underwater. I think that's a good way of thinking about portfolios. But the key part of the second part of the book was really to delve deeper into all of these constituents, and I will have to be selective here. But before I do that, I give the overall picture, and the overall picture is that if you look at 100 years of data, like I do here, or 95 years of data, or 50 or 100 or 200 plus, you tend to find that there are a few asset class premia and a few style premia that have the most consistent evidence, most consistent support for providing positive long-run returns. Each of them sometimes disappoints, but the long-run story is best for these. And you have got here, the bars are basically average premium, and then the circles there are Sharpe ratios, which you can read from the right. You have got equity premium, duration premium, credit premium, commodity premium, and then styles, value, momentum, carry, defensive. So roughly buy cheap, buy last year's winners, buy high yielders, buy the boring stuff. Sell the other side because we are talking of long-short strategies. And here we are not doing it just in stock selection. We do it in stock selection, country allocation, across equity markets, across bond markets, across currencies, in many different contexts. And it has worked in all of them. And then lastly, trend following, which is similar to momentum, but it's the only one strategy of this styles here which embraces directionality. The other ones try to be market neutral. Trend followers tend to go risk on after bull markets, risk off after bear markets. And this latter feature that they go risk off after bear markets is very helpful. And I will at the end, I will highlight that feature because it makes them quite good risk mitigating strategies. Okay. But so basically 10 years ago in 2010s, my key message was that, their equity premium clearly is important, but there are many other premia. You should diversify your portfolios across many different premia. In reality, most investors let their portfolio be dominated by equity risk, and I have changed my tune gradually because I can see that investors can have more patience with that equity risk than with any other risk. So therefore, I'm not pushing as aggressively this diversification. But therefore, I will say that once you let the equity risk dominate, let's ask very carefully what can help the portfolio when equities disappoint. And I will get to that in a few slides' time. Okay, that's going to be sort of my last highlight in the presentation then. But one other reason why I was again more cautious with these other premia is that we saw live the difficulty of investors staying patient with them. And this next picture shows you a bit more detail on the style premia. And so this is a picture of style premia in stock selection on the left, and then equity country allocation, bond country allocation, currency allocation, etc. And actually, further is to the right, you can see equity premium, just long equities over cash, and then fixed income over cash. So equity and term premium, just as classic premium on the right. In every case, the little line that you see there, which is a bit above zero, is the long-run Sharpe ratio, 100-year Sharpe ratio, which is positive for anything, which is one reason why I have had such confidence with these strategies. That I think in the long run, if they work anywhere we study, there's gotta be something into them. Of course, we can ask if the world has changed. But for real world investing, the key point is that when you look at these blue bars around that long run number, there have been a big range of 3-year performances, some more positive and many deeply negative. And those negative times have made investors give up on anything. So basically equities are forgiven, anything else is not forgiven, and investors tend to leave these strategies. And that lack of patience, I am trying to push against that and educate investors, but I know that there are realistic limits to that. And therefore, I'm a little cautious in how much I push my diversification message. As one example, if you look at the very first item there, that's stock selection value. I'll just quickly tell the story here. This is for actually 33 years of data. In the top panel, top panel, you can see cumulative performance of global value factor. And there are many ways of doing this value strategy. This is the way we tend to do it. I mean, again, we can do it in many ways, but basically we look at within every region, we ask which stocks are cheap or rich using multiple value signals, and we combine that information to create a long-short portfolio. And importantly, we don't tend to look at the whole universe, but we tend to look at within industry value opportunities. We say, let's not compare a bank to a tech stock to an energy stock. Let's get more comparability by doing industry-neutral comparisons. That type of approach gave pretty good performance up to 2017, and then horrible 3 years. And that was that I've also lived those years live, and it was very painful for any investor who had value orientation. And you can see when you look at the drawdowns in the mid panel that this was the biggest drawdown. It was not just the deepest, but also longest lasting drawdown. It was already pretty bad in 2018-19, but then just when there might have naturally been a recovery for it, COVID came, lockdowns came, and many growth stocks like Peloton and Zoom and so on were the lockdown darlings, and that was another notch down for value strategy. When the vaccine news came in November 2020, lockdowns were seen to be soon over, and value started its recovery, and we've seen that recovery since then. It's an uneven one, but it's clearly has been going that way. Lowest panel shows a forward-looking measure. How attractive are value stocks versus growth stocks? So there is this positive news then that while value strategy suffered a lot, at least it brought the strategy in a forward-looking sense into quite attractive levels, and it's been in those attractive levels, though coming down, of course, somewhat since the peak times. We think it's still an attractive opportunity, as you can see from that value spread. So we tend to favor this more than we even tend to favor it in the long term. Okay. Now, before I get to my last area, I will very quickly say something about illiquid. So I call them overrated, and I've got a couple of logics. So one is that what I show here, I'll just say, I show through the lens of private equity, US buyouts, but I think this works for many other illiquid assets. And you may raise questions on this in the Q&A section if you want, but now I just tell a very quick story. In the long run, buyout managers have had very good performance over the last 30-something years, but that performance advantage has been narrowing, has been quite modest versus public markets in the last 15 years. And what you see in the top panel shows actually not realized returns, but forward-looking returns, EBITDA over enterprise value, roughly earnings to price. And that there used to be a big gap between public and private, and it narrowed around the time in mid-2000s where the Yale model, endowment model, inspired lots of institutional capital to this space. And since then, it's been harder to make money and outperform public equity. But private equity has continued to do quite well. But I do think that now we are at the last years of its strong performance, because not only has this valuation gap vanished, which happened a while ago, also financing conditions are much less friendly. They benefited from this cheap leverage for a long time, and that's over now. But the fees are still the same old fees, and there's something like 5% all-in fees, which is very difficult to beat in this new environment where we have. So that's my main reason for caution. And the other logic is that I think this is now to the second panel here, and I say that investors take too much for granted that illiquid investments give you an illiquidity premium. Empirical evidence is actually not so great, and the logic has got the problem that it would be true that when you lock your money for 10 years, you should get compensation, if that were the only thing we care about. But there's another feature that happens with private assets. They are not mark to market. We get a smoothing service, and investors really like that smoothing service. And it may be that feature allows investors basically eat up the required illiquidity premium. That's the only way I can make sense for the fact that there is no valuation difference between public and private, and I think exposed really illiquidity premium probably is no longer there. Maybe it comes back one day, but not until there's a real repricing in the private assets. Now I'd like to get to my last section, and I got a good 5 minutes for that here, and I'm only so it is about putting all the pieces together, and all the bullets that you see here are topics in my last section. And I could talk about a lot of them, but the one where I got most passion, and you will hear it in a moment, is related to risk management and risk mitigating strategies. And if you have no questions when we get, or too few questions when we are in Q&A, I may tell you a light story about that picture here. But now I need to choose my time better, and I want to talk about risk mitigating strategies. I've already told you, I think the core idea I want to offer to you is that any investor should ask the question, what is the Achilles heel of my portfolio? What is the most important risk? If it materializes, it's really going to hurt us. And if you identify it, maybe you want to add some strategies that can help there. So since most investor portfolios are dominated by equity risk, it's fair to start this type of analysis by looking at the worst times for equities. So I had in my book this table on the left, which has got the biggest drawdowns for US equities over a century. And you can see the dates and how many months they were and how deep the drawdowns were. And then you see the performance of 5 risk mitigating strategies: index put buying, trend following, treasuries, gold, and defensive stocks. The last bit is quality minus junk US stock selection. I want to focus, all of them have sometimes worked, all of them have sometimes disappointed, but I want to focus on the first 2, because there's a lot of public debate. I've debated sometimes Taleb about this. He clearly favors option-based approaches. I clearly favor trend approaches. I think it's fair to think that option-based approaches are better in fast crashes like 2020. If you look at the second row from the bottom, you see the 2020 experience. Put strategies did wonderfully. Trend not so well. But if you get a more protracted gradual bear market, that can be quite disappointing for put strategies, and trend followers are quite reliably making money because they turn risk off and they stay risk off as long as the bear market continues. So it's really their problem can be in the fast crashes. And then it's interesting to look at the right-hand side picture, which has been my debate with Taleb. So in the long run, option-based strategies can be very costly, and that's showing put strategies long-run performance, and trend following has been able to make money. Okay, and I'll skip in the interest of time this question. There's a question, why trend following disappointed in 2010s? I think it's a story of suppressed macro volatility in 2010s, and I would have some analysis on that. But the last thing I want to highlight to you is that I just showed you that trend following has been helpful in big equity drawdowns. I want to tell that I have studied various ways of thinking about bad times. Finance theory tells that strategies that help in bad times are really valuable. But it's sort of, there's a debate, what are the bad times? I think equity drawdowns, or what I show here, 60-40 portfolio drawdowns, they are pretty good proxies for bad times. But there are some other concepts. Whatever I've tried, I tend to find that in these bad times, core portfolios tend to suffer, but trend following strategies tend to do well. And so in the top panel, you see, instead of 100 years, we show 50 years of data. Instead of showing US equities, we show global 60-40. But when you look at the biggest drawdowns there, you can see that trend following has done well. Both the classic price trend, where you look at for every asset its own recent performance, and economic trend, where you ask how the economic drivers for an asset have performed. Again, that would be a Q&A stuff, but it is interesting to complement classic trend following with this economic trend following, and I leave that for possible Q&A if you want, but you can focus just on the price trend evidence. And in the lower panel, you see my earlier point that whatever bad times we are considering, we tend to see trend following doing well when your core portfolio is hurting. That was true for 10 biggest drawdowns for 60-40 portfolio. It's true if we slice history to macro turmoil versus macro calm. By the way, it would be true if I looked at market volatility, high periods of rising and high market volatility. True for stagflations or inverted curves, NBER recessions, Fed hiking episodes. We always tend to find this thing. And why would that be? Why is there this beautiful complementarity? I think this is a nice logic, and there are some math stories around this that you can think of why trend following has got this sort of option type of pattern that we see here. But let's just focus for a moment on the top left picture. That's what I'm showing there is 50 years of data, how global 60-40 portfolio worked on an annual, how it performed annual basis at times of inflation surprises. And so it's contemporaneous relations. And it shows that basically 60-40 portfolio likes boring world. It likes nothing much going on with inflation. It dislikes inflation surprises, but it also dislikes deflationary surprises. So there's this frown pattern. And when you look at below it, you see that price trend and also economic trend has got the opposite pattern, basically a smile. And that complementarity, that trend following tends to like these large moves that your core portfolio doesn't like. I think that's a key reason why these things work. And that was on inflation, but you see something similar if you look at cash changes, growth news, or equity returns. So that's to me, my big preaching story clearly here is the complementarity of trend to core portfolios. I think investors should have strategic allocations to it. And the very last thing I want to say, actually, and before I show the picture, I will just say this, that everything I've shown now is on public equities. But if you think of private assets, including private equity, remember, you don't really have to worry with private equity about fast crashes like 2020. The smoothing takes care of that. It's a protracted gradual bear markets that are problems for private assets. And trend following is, we call a match made in heaven or a marriage made in heaven to private assets. And to give some empirical evidence, I have put here data for private equity, basically looking at the worst periods in the last 30 plus years for Cambridge Buyout Index. That's the first column. And then we show a couple of other private assets. And on the right-hand side, you can see S&P 500 and you can see hedge funds, lots of positive beta there. Basically, they were all suffering together with private equity. Government bonds were doing well except 22. And this was basically the window where government bonds had this nice safe haven property. But you can also see that anyway you do trend following, whether it's price trend or economic trend, or if you broaden the universe to alternative, basically less liquid opportunities where you could do trend following. In all cases, we find this complementarity working beautifully. So I think investors who have got big allocations to private assets should be even more interested in this story that I've been telling. And I think I will stop here, and I leave the part 3 key takeaways that go beyond the risk mitigation. If somebody wants to look at, you can. But now I'm happy to take any questions from any of you.
Okay, so thank you very much, Antti. Thank you for this great presentation. So now it's time to Abraham. Abraham, I don't know if you want to shoot some questions or comments, or if you want that we directly take the Q&A. Up to you. You're on mute, Abraham.
Yeah, so first of all, thank you very much for the talk. Super interesting and nice patterns to look at. Just a very quick question before we leave the floor to the students. So when we teach the students, we tell them to never look at expected return, but to look at expected return and the related risk. So I have a quick question for you. So did you look at the trends, for example, in the risk?
Sure.
If the risk declines, so it's natural that the expected return should decline. One. Second question, and then I'll let you answer. When we have one crisis every 50 years, it's fine to look at the Sharpe ratio. But when we have one crisis every year or every 6 months, the Sharpe ratio, which think of normal times, is no longer is completely irrelevant because of the asymmetry. It can give completely false recommendations. So how do you adapt the metrics if you want to incorporate risk to this kind of turbulent times? Thank you.
Sure. Okay. I'll quickly answer the latter one just there. First, saying that the typical things, so going beyond mean variance environment, which basically would justify the use of Sharpe ratios. You certainly want to think about higher moments. You want to think about illiquidity and maybe leverage. So with higher moments, it can be as simple as looking at, let's say, biggest drawdowns or some asymmetric measures, or just before. I do think, what I'm trying to do here with, for example, this table is really going to those crisis times, and this is a very lowbrow way of doing that, but so it is not looking at Sharpe ratios, but it's exactly trying to zoom into the things, the crises that matter most. So that's something. But then really, especially with trend, to your first question, expected return and risk, I think it is always a good way to start by thinking about expected return and risk. But trend following, and to some extent the defensive stocks here, have got this problem that they have got weirdly good performance. Like I have just documented to you that trend following has historically had positive long-run Sharpe ratio, and actually, like, I can do 200. We have done a work 100 years, and I think CFM people there in France have done 200 years of trend following. Every decade has been successful. 2010s has been the only one where it looks pretty flat when you look at 200 years of data. And yet the strategy has got, I would say, as good as it gets safe haven service. This is something you cannot explain from risk perspective. So it is, and by the way, that means some investors, for example, again, Norway sovereign wealth fund that I advise, said, it's a simple strategy, it's a naive strategy, and it has got weirdly good historical performance. It must be RWA yesterday, or today, or tomorrow. So they just can't believe that. Clearly, the logics why trend following work cannot be explained by risk-based explanations, because this is exactly showing to be a safe haven besides maybe positive returns. I do write always in my text that this is too good to be true. This is what has happened historically, but it can't be this good in the future. Either probably some combination of lower expected returns, lower Sharpe ratios, and whatever expected return type of metrics, and disappointing risk performance. They must be somewhere there in the pipeline. It's right to think about, for example, trend following really could suffer if you go from a risk on world to sudden risk off. That could be horrible. Turns out in 2020, when that happened with COVID, it turned out to be not quite too bad. But ultimately, while it's very good to start from expected return and risk go hand in hand, trend following certainly has got track record that is very difficult to reconcile with it.
Okay, thank you.
No more comment, Abraham?
No, I saw on the slides, but you didn't comment on this. What about the sustainability puzzle for the last 5 years? So is it where the hope is for investors?
So sustainability.
Yeah.
So I'm certainly from the camp who doesn't think that there's a win-win for everything. So it would be lovely if we can always get virtue together with good performance. But I think I go more with the finance textbook idea that constraints tend to reduce returns, and if people wanna want to avoid some sinning or brown companies or so on, they probably have got higher expected return as a result. So what has happened in the last few years, I think, before 2022, I think was part of basically the world moving to the direction of pricing more highly the virtuous, clean companies. But the end result of that is likely to basically give higher expected returns to the sinner companies. I mean, there is a possibility that some brown companies, for example, are going to totally disappear, and then there's going to be sort of double punishment on them, first cheapening and no recovery from that. But as a base case, I think virtue tends to have some cost, but it may well be worth. Investor preferences, certainly in Europe, are saying, I think, even though it's often investors are not asked whether there's a trade-off, they are just told that there's a win-win outcome. But if there's a trade-off, I think many European investors would say we are happy to pay some lower expected returns to get various sustainability benefits. And then finally, I was huge topic. So you are throwing. I just have to sort of run through quick points. There are some pockets, some indicators, I think, where you can get win-win. So better governance, for example, if you think of that. So some companies that have got poor governance, they are bad, certainly bad from ESG perspective, and they are likely to perform poorly, and vice versa on the good side.
Okay, thank you very much.
Thank you.
Thank you, Antti. So there is one question in the Q&A chat box, and please, the students, do not hesitate to send other questions. That is related to private assets. So the question is from Sebastian. There's been a large inflows in private assets in the previous decade, mostly due to the low real returns in public markets. Do you think that the interesting time in which we are now will be a main challenge to the private asset business? And I have a related question because I know that you work a lot on the private market space. If you can also elaborate on the so-called smoothing service of private markets, I think would be also interesting for the audience to have this perspective of an asset allocator on private equity. So the first.
Yeah. So I was rushing through those stories really here on page 15, but I try to be very even-handed where I tell the story, but ultimately, of course, I am skeptic, and you can question my skepticism because I am a liquid manager and so on. But I've had to talk to investors about their total portfolio. So I did lots of research. I had a paper on demystifying private equity, demystifying real estate, sort of trying to use the concepts we use on public side to think about these things, and that kept, let's say, made me more skeptical. I already told very early in the presentation, I just told that there's a very short-term topical thing that we got this increase in 10-year TIPS yield from -1 to +1.5, and private equity and real estate haven't repriced almost at all. I don't think that is realistic. It's core part of their discount rate, and they are long duration investments. So the fact that they don't cheapen at all is unlikely to stand. But then the broad story that I have here in this top picture is that there was a beautiful history in up to 2006 or so, where private equity was outperforming a lot. And actually, like, the really positive story, just to say, is that since 1980s, private equity has outperformed S&P 500 by about 3% a year. And this is after huge fees, 5% fees. That's 8% gross alpha. Congratulations. But then the questions come that most of that outperformance came when the industry was smaller before 2006. And since then, it's been harder to outperform. Still some outperformance, but in a world where leverage was very cheap, and actually private equity also had very good benefits from having shifted from small cap value tilt to small cap growth tilt. So they were clearly favoring the right industries, growthy companies in 2010s. More recently, that hasn't been helpful, and I think that's going to be a headwind in the future. So I do think that this basically, we are in a world where there is no valuation edge anymore. There is no cheap leverage. The growth tilt is not helpful, but you still have to beat those 5% fees if you take all in the various fees that private equity has. And I think it's going to be very difficult for them to outperform. And this is true now for the collective. There will be superior managers, of course, always, and there's very wide dispersion between manager performance. But I do want to remind that the dispersion has got both positive side and negative side, and everybody seems to think that the negative side is for somebody else, not for us. So I think humility is helpful in that space as well. So that's that. And then the second point, which is on smoothing, is really, it's a somewhat overlapping story, but it's a story of saying that don't think that you can get illiquidity premium and smoothing both, because we may be double counting if we do that. If I'm an investor who thinks that I should get 3% compensation when I lock my money for next 10 years, you could then say that maybe I'll do 2% or 1% premium. Maybe I will accept the same return as for public equity, because with privates I will get half the volatility. And this is, I think, what investors have often chosen. And actually, what the pictures that you see there in the mid panel are not just any pictures. On the right-hand side, you see the cumulative performance of Cambridge Buyout Index from 1986 to 2020. It only has got the dot-com drawdown and GFC drawdown. And on the left, you see a small-cap public equity proxy. Very similar long-run returns, but much more volatility, of course, for public assets. And I tell in the book that in GFC, this Cambridge Index had 25% drawdown. Small-cap public stocks had 60% drawdown. Which one would you prefer? And my message is that there is really something useful. I think there's lots of fishiness and questionable things about the smoothing, but if you can take that smoothing, it's helpful because it allows you to take bigger equity portfolio, bigger allocation to equities, earn more equity premium, and you can stick with it better when you don't get 60% drawdown. It was at 60% drawdown that made many people capitulate in 2009. 25% drawdown allowed people to be more patient. So I'm saying that there are benefits to smoothing, but they don't come for free. They come at the cost of us collectively eating away that illiquidity premium, which you can also see from the valuations. So don't expect to get illiquidity premium in the future. And maybe if I can, I'll just throw one other thing. Look, if we look at the longest history that we have on sort of very direct evidence on illiquidity premium, it comes in real estate. In US, we have got data from 1978 from NCREIF, direct real estate index versus the REITs, listed REITs. And actually REITs have outperformed by 5-6%. So there's a negative illiquidity premium. And then when people have tried to say that, okay, there's positive beta and leverage and different sector compositions, and we should adjust for those, they can explain much of that negative towards zero, but there is no sign of a positive illiquidity premium. So again, empirical evidence on illiquidity premium private assets is not what people think.
Thank you very much, Antti. So I have another question, and but there are so many stuff that we can discuss all together. So you work on expected returns. You produce as other big actors, financial actors. You provide capital market assumptions. Do you actually, and if you do, how do you do it? Do you integrate the impact of climate change on the expected future performances of various asset classes? So how do you do it?
Yeah, and so some do, and we haven't done it partly because there are too many question marks to us on that one. And it probably would be, the most important things would be then sort of emerging markets versus developed markets, but this is somewhat related to the question on like, do you look at, let's say, scope 1, 2, or scope 3 emissions? You know, like the developed world and tech companies and so on look very innocent when you avoid scope 3 perspective, but when you look through, try to look through at the supplies, things get different. So I think the implications would be pretty negative for emerging markets and vice versa for developed markets and especially tech industry and so on. But I think we just find too many question marks. We have not integrated it there.
So you have not looked at, for instance, the impact on growth, the impact on inflation. There are some macroeconomic sensitivities.
Certainly, but I think there are debatable conclusions even on the sign of these things. The growth impact and the inflationary impact, I think, like I could hear very rosy tinted stories or very negative stories depending on who is speaking on this. And given this uncertainty about that, we have decided not to. I mean, we get lots of research on this area, but tying it to those macro prospects, we just it's somewhat similar to thinking about demographics. We just find that the signs are too unclear for us to. We know that these things are important, but we just cannot. We don't have confident enough signs on those macro sensitivities to want to influence our capital market assumptions with them.
So we get a couple of questions, so perhaps I will take two before we close this session. One is from Romain. So you mentioned that long-short equity strategies perform better during times of higher rates. Do you believe that the current economic environment could favor active managers over passive managers?
I think there's something, certainly higher macro volatility is helpful for macro managers and trend. And then there's another idea that higher dispersion should help more the stock pickers. So there's some evidence that suggests it, but so far, you know, the early results from 22, 23 haven't been great. So there's this. I feel a little bad that my strongest view here is that high macro vol is good for trend and macro. That's the one where I trust the data most. Otherwise, I don't see it. I think there is still a chance that we'll continue to, you know, there's been this continued trend towards more passive, and I suspect that somehow that may have to continue until active managers start to collectively do better, not just on a particular year, but sort of on a multi-year basis, and we are not yet there, it seems.
Another question regarding the high potential expected returns for fixed income securities in the coming years. Do you think that we are at the beginning of a golden era for bonds? Or do you think that current monetary policies are structural and we will stay in a higher rate regime for a while? So that's
thank you. I'm an old bond guy, so I should have, but I think the uncertainty here is really huge. So I do. So I'll really give very two-handed answer. It's a undeniable fact what you saw early in the presentation that bonds have repriced. You know, like the fact that people lost money now in bonds in 2022 should be water under the bridge, and they should think that prospectively bonds do look clearly better than they looked all of 2010s, and especially relative to equities and other risky assets. So that's good news. And I don't know whether it's golden age, but at least certainly, you know, bonds are not dead in that sense. So and I think they are more attractive than they have been. That said, I do, like I told you of some of my worries of this inflation picture. I am a bit in this camp when I put it on discretionary hat, where I think that the inflation problem is not as over as market and economic forecasts tend to see it. I think there is a chance that we don't get those last 2% away from inflation, or that we get a rebound in inflation sometime if economies are not weaker. And I think, like, you know, all this talk that there was of central bankers maybe adjusting inflation targets higher, I think that would have been a horrible mistake, because they really need to retain their anti-inflation credibility now, so that we don't get to this world of higher inflation uncertainty, which would have a triple whammy effect in bond yields through expectations, through higher inflation risk premium, and through losing the safe haven premium, which I told is also related to inflation uncertainty. So I think there's a vulnerability there, and I didn't even talk about, you know, the fiscal problems, the government deficits which are there. So there are lots of challenges, I think, for government bonds. At the same time, you know, the yields that we are seeing already, they do look attractive compared to riskier asset classes, I would say. But maybe the last point I want to say, I think too often people were thinking of the rich world, that this was just bonds, and now, so I do think that anything that happens to bonds has got lots of implications for other asset classes. And sometimes those other asset classes seem to forget it, like what has happened with that rise in real yields and real estate and private equity and even public equity to some extent, trying to ignore that.
Thank you, Antti. Just before we conclude, there was a slide 16 with this picture on with apples. Do you want to take some time to explain what is?
Oh, okay. Yes. Okay, that's nice of you. So this is actually, so I had written, when I joined AQR in 2011, I had written this massive book on expected returns, and I sort of felt guilty about it because I realized then that I had really given short shrift to other parts of investment process, portfolio construction, risk management, cost control, important issues that are often somehow not noticed as much. And I thought that really, when I joined AQR, the first paper I write in AQR should be about these other things. So we wrote a paper with my colleague Dan Villalon about alpha beyond expected returns, about these other things. And Dan found this wonderful picture of apple harvesters to describe what we are going to do. And I put this was so fitting that I put it also to this book. And basically the story here is that if you look for the lushy apple at the top, the high expected returns, you may miss the low-hanging fruit. Look in this picture how poor diversification they've done in this setting. The little girl, all the apples have been put to one basket, so poor diversification. Think about risk management when they leave that little girl under the ladder. And cost control, not so great when only one of the two adults is working. And then a colleague of mine, after the book went to print, said that there's actually even a modern ESG angle that we can add to this picture: child labor. So I think it's about serious issues, but it's a light and memorable way of seeing these other issues than expected returns that we should think about when we are thinking about investing.
Okay, thank you, Antti. Really perfect conclusion. So thanks again for the time. Thanks for sharing your expertise. Thank you also, Abraham, for participating to this first session of the third season.
Thank you,
we will be back. We will be back on the 10th October with Jules van Beersbergen from Wharton that will talk about impact investing. Thanks again, and thank you, Antti. I would love that we spend more than 1 hour together, but I hope that there will be another opportunity. See you soon. Merci beaucoup. À bientôt. Bonne soirée.
Merci beaucoup.
Thank you, Antti. It was great.
Bye.
Bye.
Thank you. Bye-bye.